Hello everyone, this is Jordan and this video market update is being recorded Sunday evening, February 16th, 2014. Starting off here, I have a chart of the CCI, which is the Continuous Commodity Index. I personally prefer this index to the CRB because the weightings in this index are much more balanced and it gives a better look, in my opinion, of what's happening broadly with the commodity sector. The CRB, which is more popular, is far too energy heavy, in my opinion. Now, recent happenings here are very significant. We see a breakout from the downtrend, and this is a downtrend that's been in place for almost 3 years. So that's very significant. We've closed at about 534, I'll round up, and we've put in strong support around 500. And the CCI has really been basing since last summer, since about, or I should say, basing around the 500 level. And we had very strong trendline support dating back to 2001. And sentiment has been extremely negative for many months. It was really negative in December when I looked at many different things. So this is not a surprise to see what looks to be a confirmation of a major bottom and a major breakout here. And we'll just have to watch. Only time will tell if this is the start of the next leg up in the secular bull market for commodities. And another point I want to add before I forget, on the bottom there is the width of the 200-day Bollinger Bands. And essentially, when the width gets very low, that tells you that there's very low volatility within the trend. And so when you have low volatility for a while, it sets up at some point the potential to get a strong move accompanied by stronger volatility. So we obviously haven't seen volatility for several years, and that's something to look for, maybe greater volatility in commodity prices this year. And one thing that could be underpinning that breakout is the fact that the US dollar index really looks terrible. I plot it here going back to 2007. You can see the rally from 2011 to 2013. Went from about 73 to 85. But this rally peaked and it didn't make new highs. It didn't exceed the highs that the dollar had in 2008 and 2010. And what's really bearish is the fact that the dollar failed at the 400-day moving average twice in recent months. And most recently, you can see that the moving average is sloping down. So it's confirming that the long-term trend, or the longer-term trend, I should say, looks to be turning down. And again, the dollar index failed pretty decidedly at that moving average. Now, the dollar is just hanging above 80. The next strong level of support is at 79. If 79 gives way, there's going to be a lot of downside, and the dollar probably won't find support until around 74. Now, one thing to mention is that precious metals and commodities will sniff out this dollar weakness before you actually see it in the dollar. So in other words, if we see commodities and precious metals really explode to the upside in the short term, then that can be an indication that the dollar is going to break 79. Next, I have a chart of the CDNX, the Toronto Venture Exchange, which is a good proxy for junior mining and junior exploration. There's a lot of different types of juniors in this index, as far as there's some gold juniors, silver juniors, companies involved with copper, base metals. There are some tech companies and a few healthcare companies in this index. So it's not a perfect proxy for the junior world, but it's a pretty good proxy. And in January, this index hit a 9-month high. It broke out there, and it pulled back into early February. And it was able to hold, as you can see, hold above the 200-day moving average. And since then, it's moved nicely higher and has almost reached 1,000. It's hit a new high. It's bested the January high. And we can see that the 200-day moving average has curled up. It's now sloping higher, indicating a new bullish trend. And this market has not been above its 200-day moving average since early 2011, so since about 3 years. And I see plenty of room for this to be able to move higher in the near term. The next strong resistance you see isn't until in the high 1100s, maybe 1170 or so, and the index closed just below 1,000. So in the short term, this move can continue to the upside. And this is a chart that I had posted in a subscriber premium update earlier today. And in black, what we're showing is the average of the 1-year rebound from 3 different bottoms as far as the gold stocks: the 2000 bottom, the 2005, and 2008 bottom. The red is the average of 2 major bottoms in the 1970s, the 1970 and 1976 bottom. That uses the Barron's Gold Mining Index, which is less leveraged and less volatile than the Huey Gold Bug. So we have to keep that in mind. If you see the red is up about 65% after 1 year, in HUI terms, roughly I would guess that's probably equivalent to being up 80%, maybe 85%. So that's something to keep in mind. And the blue is where we are as far as this current move, the major bottom that began in the middle of December 2013. So we'll see how this tracks over the coming weeks and months. But so far, it looks like it's in line with the 2 analogs. That's all for today. Thank you so much for listening. Check out my website, thedailygold.com. I have a free newsletter you can sign up for. In the top right corner, there's a couple of free reports that you'll get immediately upon sign up. And you can also consider our premium service where we focus on market timing and stock selection. That's at thedailygold.com/premium. Thank you so much for listening, and you can email me your feedback, Jordan@thedailygold.com. Thank you.